Welcome back to The Explainer. Today, we're putting biotech giant Amgen right under the microscope. We're stepping into the shoes of an expert investment analyst, applying the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham to see exactly what Amgen's Q1 2026 reality actually reveals. No market noise, just the numbers, the pipeline, and the clinical realities. Let's get into it. Okay, let's take a quick look at our roadmap. We'll start by establishing a baseline snapshot of the company. Then, we'll layer on the qualitative guru assessments from Buffett, Lynch, and Graham. After that, we're going to crunch the hard numbers with a discounted cash flow and other quantitative models before bringing it all together for a final synthesis. Section 1. Snapshot, the Amgen baseline. You probably know Amgen. It's a global biotech titan, historically famous for blockbuster therapies in oncology, inflammation, and rare diseases. But right now, they are navigating a seriously critical transition. They're staring down massive patent expirations for their legacy drugs while simultaneously trying to launch a whole new wave of clinical breakthroughs. So let's look at the raw data for Q1 2026. Sitting at roughly $374 a share, Amgen is rocking a $201 billion market cap. They pulled in $8.6 billion in revenue for the quarter. That's up 6% year over year. And they're actually offsetting those severe patent cliffs for legacy drugs like Prolia, with 16 different brands hitting double-digit growth. They've also got $12 billion in cash on hand, though we do have to note that hefty $57.3 billion debt load, mostly stemming from their Horizon acquisition. Section 2. The Warren Buffett lens. Buffett's framework is famously straightforward, right? But it is incredibly rigorous. He wants honest management, consistent earnings, manageable debt, a high return on equity, and a rock-solid economic moat. But the real key here? He evaluates a company based on its owner earnings, basically the actual free cash generated for the owners after you subtract capital expenditures. So how does Amgen stack up? Well, they definitely possess a wide economic moat, heavily fueled by that newly acquired rare disease franchise and a booming $3 billion biosimilars business. But that moat is actively being challenged by those patent expirations. Earnings consistency? Incredibly strong. Fitch actually expects their EBITDA margins to hover right around 47 to 49%. Now, that $57.3 billion debt, it does give you a slight pause for sure. But with a solid BB plus credit rating, it remains highly manageable. And this brings us to Buffett's true north, owner earnings. Wall Street projects Amgen's free cash flow to surge to an estimated $13.41 billion in 2026, mostly as one-time R&D charges finally roll off. Buffett would absolutely love this cash generation, not to mention the growing 6% dividend. But he's a strict value investor. He demands a wide margin of safety, so he'd likely want a pretty significant discount from today's $374 price, probably looking for an entry much closer to the $300 to $350 range. Section 3. The Peter Lynch lens. Peter Lynch loves categorizing companies to understand exactly how their stock should behave. Is it a fast grower, a slow grower, a turnaround, or maybe a stalwart? And to figure out if he's overpaying for that growth, he relies heavily on the PEG ratio. He divides the PE multiple by the expected earnings growth rate, ideally looking for a PEG of 1.0 or lower to find real value. Let's run the math. Based on the current price and a forward EPS guidance midpoint of roughly $22.38, we get a PE multiple of nearly 16.7. Now compare that against their expected growth. Revenue compound annual growth is projected between 3 and 4.8% through 2028, with EPS growing in the low to mid single digits. That gives us a PEG ratio well over 3. For Lynch, paying a multiple of almost 17 for a company growing at maybe 4%, yeah, that's just far too expensive. Because of that, Lynch would definitely label Amgen a classic stalwart. It's a massive, highly profitable company that offers a ton of safety and a fantastic dividend payout. But it just lacks the aggressive growth profile or the cheap PEG ratio needed to trigger a strict buy. So for Lynch, it's a solid hold. Section 4. The Benjamin Graham lens. Okay, Graham's defensive investor checklist is notoriously brutal. He demands adequate size, a flawless financial condition, continuous dividend records, and extremely moderate valuation multiples. Amgen easily passes the size, earning stability, and dividend tests, but it completely fails his strict asset valuation rules. Graham wanted a PE under 15, and more importantly, a price-to-book ratio under 1.5. Amgen's current price-to-book sits way up near 22. Let's actually do the explicit math behind Graham's famous intrinsic value formula. which blends earnings and book value to find a fair price. Step 1. We take the expected 2026 EPS of $22.38. Step 2. We calculate the book value per share. $9.19 billion in equity divided by 544 million shares gives us $16.89. Step 3. Apply the formula. We multiply 22.5 times the EPS times the book value and take the square root of the whole thing. Crunch those numbers, and Graham's strict formula values Amgen at just $92.21 per share. This means at today's price of $374, there is literally zero margin of safety in the traditional hard asset value sense. Graham wouldn't touch this stock without a massive discount. He'd view the current premium entirely as speculative future growth, rather than tangible current value. Section 5. DCF and quantitative valuation. Now, let's leave the old-school qualitative models behind and look at the hard quantitative data. A massive driver here is Amgen's free cash flow, and this is where the story gets really compelling. Their free cash flow is projected to leap almost 65%, from $8.1 billion in 2025 to a staggering $13.41 billion in 2026. This huge jump happens because one-time R&D charges from business development are finally falling away, really revealing the true cash-generating power of the underlying business. Using those robust cash flow projections, we can build a base case DCF. If we assume a pretty conservative mid-case revenue growth of 3% through 2030, net income margin expansion up to roughly 35%, and a standard 8% discount rate for a BB Plus rated company, financial models from platforms like Ticker give us a fair value target of $468 per share. And even if we run a sensitivity analysis, slightly varying that discount rate or terminal growth, the math still implies significant upside from the current $374 level. And this bullishness is backed up by alternative quantitative models too. Take a dividend discount model. Using their current 10.08 annualized dividend, projecting a historical 6% growth rate, and an 8% cost of equity that easily supports a fair value north of $500. Also keep in mind that comparable multiple analyses often fall short here, mostly because they struggle to price in the massive potential value of late-stage pipeline drugs like their obesity candidate, MariTide. Section 6. Final synthesis and verdict. So here is our master's synthesis table, and it is a fascinating split. Strict asset-based value investors like Benjamin Graham see Amgen as drastically overvalued, a hard pass. Peter Lynch views it as a solid but fully priced stalwart, a hold. Warren Buffett might be tempted by the massive owner earnings and the economic moat, but he'd likely wait for a slightly larger margin of safety, putting him in the hold or weak buy camp. On the flip side, forward-looking cash flow-based models and growth projections see immense upside, signaling a strong buy with targets pushing toward $468 and beyond. On the flip side, ultimately, the stock's future hinges entirely on a really delicate balance. On one hand, you have explosive free cash flow, 16 different brands growing by double digits, and the massive, potentially world-changing upside of their clinical pipeline, specifically that MariTide obesity drug. But on the other hand, you have incredibly severe risks. The impending loss of exclusivity on legacy drugs like Prolia and Xgeva threatens $6.5 billion in base revenue. Add in a heavy debt load and a lingering $10.7 billion IRS tax dispute, and you've got a real layer of uncertainty. We've laid out the frameworks, parsed the clinical realities, and crunched the hard math. The final verdict really rests on a razor's edge between legacy decline and clinical revolution. So the question goes to you. Looking at this risk-reward profile and knowing exactly what the greatest investors of all time would do, at what exact price does this biotech specimen become an absolute must-buy for your portfolio?